Okay, we are going to look at numbers with a different product this time. In the past two videos, we looked at a limited pay product, a 10-pay whole life product with Mass Mutual, one of the four major mutual companies, and we looked at the 10-year funding option and also the 7-year funding option. Really interesting how those two products perform differently, or the same product performs differently with different funding scenarios. Now, in this video, we are going to look at an L95 product, which I refer to as a hybrid whole life insurance policy, mainly because it provides strong early cash values without giving up that much over the long haul. So what we've got here in respect to the 7702 update is the old product had a guaranteed rate of 4%. The new product has a guaranteed rate of 3%. What was the guaranteed rate on the last two videos? 2% with that limited pay, the 10-pay product. Now we've got a 3% guarantee. And the main reason why, this is with Guardian, and Guardian filed all of their products at a 3% guarantee, which keeps it simple, and personally I'm a fan of, but I'm a fan of all the companies. Anyway, my point there to mention the difference in the guarantees is with the new product in the last video, what was the guaranteed rate? 2%, but what was the death benefit? At 2%, it was about 1.5 million. Now, if you're really trying to make sure you follow to say, wait a minute, are things really equal here? The death benefit, that is important when the guaranteed rate is different. When I have a 3% guaranteed rate, I only need the death benefit of about $2,050,000 to obtain the same $100,000 MEC limit. So let's get on into it here. We're going to look at a 5-year funding period in this video. The next one, we'll look at a life pay. So what we will look at first, the guaranteed values, then the dividend values. This will be very interesting. Old product, based on the guarantee of what? 4%. MEC limit, $100,000. Death benefit, $2.8 million. When we looked at that 10-pay policy, what was the death benefit there on the last video based on the old product? It was about $2.8 million. So when the guaranteed rate is the same, 4% with two different companies, that $2.8 million death benefit, that gives me a $100,000 MEC limit. Why I'm emphasizing this so much is when we see different death benefits, that can be confusing. But really, I just want to lean into the point that these are designed for minimum premium, minimum death benefit, maximum cash value. So old product, about 89% right off the bat. That's a cash-rich policy. IRR, there's the annual IRR, break-even point, based on the guarantees, pretty much year 5. You've paid in a total of 500 grand and you've broken even year 5. You're at 497 in cash value with the 4% guarantee. Now the new product, we have an identical base premium. They're minimized. They're both around $9,000, a little bit less than 10% in these examples. However, what do you notice here? 100 goes in. Are you at 88%? You're at about 84%. So why would it be so much less with the new one? There's a term rider attached, but it costs less. The death benefit's less. The reason why is all companies have PUA fees, and what this company did, they actually increased their PUA fee. It used to be 5%, now it's 10% with the new 7702 update. And they did that really as a means or as an effort to enhance the long-term performance. And you'll see that when we look at the non-guarantees. But that's why that first-year cash value is not as attractive. IRR, we've got less here. You see about a 5% difference there in cash value. It's interesting. That's the extra charge. This one has a 5% PUA fee, the old one that is. New one, 10%. There's your difference. As time passes, though, you've got a higher PUA fee and a lower guaranteed rate, breaking even between years 8 and 9. Year 8, you've paid in 500, you're at 496, just about there, which, by the way, is still solid for a dividend-paying whole life insurance product. Breaking even just about year 8 with a guaranteed rate of 3%, that's strong. Now, as time passes, what do you notice on the IRRs? tops out at almost 2.6%, whereas this guy tops out at about 3.3%. It's not a full percentage point less. You would think that it would be. Common sense would tell me, hey, if I've got a guarantee of 4% and it goes down to 3%, my IRR should be a full 1 percentage point less. 4 minus 3, that's a 1% difference. Why it's not is remember that your insurance expenses came down as well. So that's why I see not quite a 1% spread. But with that said, there is a difference over time. As I look at, let's look at age 65, old product, what do you got? $952 in cash value. New product at age 65, $770 in cash value, $180,000 less in the new product than what there is in the old one. That's a difference due to that lower guaranteed rate. So that's the drawback. The trade-off is weaker guarantees, with the advantage being the non-guaranteed values. So the dividend rate with this company is 5.65%. With the old product, which we have on the left, I'm going to use a red pen here. What this means is if you have a guaranteed floor of 4%, that means they are crediting a surplus of 1.65%. Add the two together, you have the total dividend rate. This dividend column here reflects the surplus of 1.65% only, meaning the guaranteed rate of 4 is not included in this column. When we look at the annual dividend column on the new product, you have a guaranteed rate of 3%, which means you have a surplus of 2.65%, which is what that annual dividend column represents. Look at the second year. What's the difference between the dividends in favor of the new product? However, when you look at the cash value, which product is more favorable? In favor of the old product. Break-even point on the old product is when? Split down the middle between years 3 and 4. The first year cash value, that takes the biggest bite out of the product more than anything else. That 88 to 89% compared to almost 84%. Still, not bad, but as I look at it, there's a difference. Break-even point, year 5 on the new product. Now, as time passes, this is where you will see things become more attractive on the new product. And really, it is more dividend sensitive. And you'll see that as we just look at the dividend values over time. If you compare and contrast, you see a big difference. Look at age 50. $5,000 dividend, which is the surplus only on the old product. And over here, almost a $14,000 dividend payout. But again, if the dividend rate adjusts, you're going to see more of an impact on dividends than what we have in the past. For the past several years now, in this low dividend rate environment, the guaranteed rate has been driving more of the growth. Now, it's more so going back to dividends, kind of like it did back in the 80s when you had a 4% guarantee and a 10, 11, or 12% dividend. Different time back then. But we do see the potential here. Let's go down to age 65 like we did in the guarantees. Cash value, about $1.2 million on the old one. New one, at age 65, about $1.3 million. Almost $125,000 more in the new product compared to the old product. So a dividend enhancement, but also lower insurance expenses. That's going to help push it up over time. Good to be aware of that stuff. You can't go wrong with the new one by any means. And why I phrase it in that manner is I do like stronger guarantees. That's just me personally. Doesn't mean you have to have the same mindset. That's not how I mean it one bit. But I do like the stronger guarantees. That's why I like that older product. I like the stronger upfront values as well. But I will take this policy out as time passes, the new product, because it's still extremely solid as I look at it overall, and it does have greater potential. But it's interesting when I look at this update and I see the guaranteed rate lower, and the guaranteed values are lower, but then when all things are equal, same dividend rate of 5.65%, the insurance company is attempting to position their product in a manner where we do see potential, where I've got greater long-term performance. So they're saying, hey, I cannot give you what I used to give you in terms of the guarantees. But with that said, with the changes that are occurring in the industry, we are going to try and develop our product in a means where if we benefit long-term, you will as well. They're a mutual company, so the policyholders technically own the company anyway. So they're trying to benefit everyone. And the same is true of the last two videos we looked at too. But it's interesting how it works. So hope you enjoyed this one. Hopefully you like going through these numbers. Please hit the like button, subscribe for more, and we will talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.